To buy or build a home, that's the question most of you have been asking us on the Land Conversation. And on today's episode of the Land Conversation, we talk matters mortgages. Do they only apply to home ownership, or can they apply to land buying and building your own home? For more on this, I'm joined by John Kaburu, Regional Manager and Head of Mortgages, Absa Bank. Many thanks for talking to us.
Thank you, Lillian.
I think a good place to start would be, what exactly is a mortgage?
A mortgage is a loan that you take to either buy a home or to build a home, or a loan that is secured by a developed property. So whether it's a residential home, whether it's a rental unit or a commercial property, that would fall within the line of a mortgage. And we are in all those spaces where it is either a residential mortgage or a commercial mortgage. When you come to the residential mortgages, we will be talking about 3-4 types of customers. The first customer is the one who wants to buy a home. This is where you want to buy a complete house, and we pay the seller of that house, and you're left paying for the loan of that house over time. So that is what we'd call a straight purchase mortgage. So a ready house, and we give you a loan over a long period. The essence of a long period is to ease the repayment period, the repayment amounts. Then straight purchase, then we can come to building. Building, and that's a very common path that Kenyans use to own homes. We have several routes. You can either be having a plot or you don't have a plot. If you don't have a plot and you want to acquire a home through construction, we can finance you up to 20%, and all you need to have is the approved plans. Then once they are approved by the necessary authorities, we can finance you up to 20 years. The third type of mortgage is what we call an equity release. And this talks to those people who may have owned their own homes or residential apartments, and we finance up to 15 years. So the idea is to unlock the value that you have in that property. We give you a long-term financing, which means, again, you have lesser repayments, and you're able to do another project, whether it's taking your kids to school or doing another investment. So that would be falling under what we call equity release. The fourth type of mortgage is the one that we call remortgaging. You may have a mortgage with another financial institution, and you find that that interest rate may be higher due to different offerings that are there in the market, and you want it taken over by a bank that is giving you lesser interest rate. So those are the 4 types of mortgages that we have in the market.
Let's talk about who is eligible for a mortgage. Old wives' tales dictate that persons who are salaried are better clients for financing institutions. Is that factual?
In terms of eligibility, any bank would be looking, any financier would be looking to the customer's ability to pay, whether that person is salaried, whether they are in business, or they are professionals. And I think there's also another perspective of people who are in real estate, because those are the 4 main income streams. Someone is either salaried, very easy because that is very predictable. Someone who is generally employed, you can predict their income. Even if they change employment, they're likely to play in the same league. For professionals, we also have a way that a professional can be analyzed from your professional income, whether you're a doctor, engineer, architect. We can see your pattern over time, and we're able to gauge your ability to pay. The other bit is for business customers who are either in trade or rental. For rental, it's a bit again stable. So that then the one that would be a bit more technical is the one around the trading customers, where you want to know the sectors that they are in. But for all the 4 income streams, we have a mechanism of establishing the primary one, which is affordability or ability to pay. The second bit that would come in is your credit history, because that is also very critical. Since it's law in Kenya that anyone who borrows somewhere, they are listed with credit bureaus. So the credit scores, they also come into play as to how much someone can qualify. The third bit is what we call serviceability in terms of the total loans that you're servicing as a proportion of your income. So that is again a piece that is linked here to ability to pay, and it's also talking to your wellness in terms of managing your cash flows and your finances.
John, you talk about stretching the repayment periods to a long period to ease payment. But that's exactly where the problem lies, because as people age, their spending power perhaps depreciates. When you're younger, you have less responsibilities. As you age, you find that a lot of people might, either get out of employment or might not be doing so well financially. So when you stretch the payment period, doesn't this then create a problem in itself?
The essence of giving you a loan for a long term is to ease repayments. Because mathematically you're saying, if I give you 10 million to repay in 5 years, you will pay far much more than the customer will give and ask them to pay over 25 years. So the issue of affordability comes in through the cash flow piece of it. I'm looking at it from aligning the mortgage conversation to your overall financial goals and plans. Affordability is, I'm earning X amount, how does it go into servicing loans? So if you look at a month today, how much money am I using to pay my loans? The mortgage included. And remember, for the mortgage, it's a basic, it's towards home ownership, which is talking to a basic need of housing. It talks to the social status that you have. But most importantly, it's also an investment, because over time, it appreciates. So it's something we want to make it easy for that customer to enjoy having that mortgage. Now, when we have given you the loan, as much as we'll give it for long term, there are sweeteners in that we allow you to fast track the loan repayment. Remember, if you take the loan when you're younger, your income will start growing over time before probably your kids go to higher schools, meaning you have some extra cash flows in between, which at your convenience you can repay early in advance. That reduces the total interest incurred, but most importantly, it helps you accelerate that loan.
You talked about there being mortgage facilities that are available for persons who want to buy a parcel of land and build a home. Now, on the land conversation, we have previously spoken about fraudsters and a lot of delays even with issuing of title deeds. So how does the bank stand in the gap in terms of protecting the client and the whole land acquisition process?
There are several options available to ensure that there is enough due diligence. The first, of course, involves the client themselves undertaking some due diligence. And we always encourage customers, even as we engage in a property, do some local due diligence to start with, at least to understand who could be the owner, is there history, and that you can always get it locally from the neighborhood of that property. But professionally, it's good to also involve lawyers, it's good to involve valuers. So what we do is we involve professional valuers at several stages. So when you're buying, say, a piece of land or a house, before we disburse the funds, we want a valuer to go and do due diligence, both on the registration of the land, the location of the land, and whether it has any environmental issues that could be involved, or it has maybe legacy issues around the titling. So a valuer will do the first level of due diligence. Then after they have done the evaluation, there's also the second level where we involve a lawyer who is going to do the registration. That lawyer also does an independent due diligence on that property. So those three levels where the customer has been involved, the valuer has been involved, and the lawyer has been involved, they provide sufficient cover around the due diligence aspect.
A question arises about the total loans. One is financing vis-a-vis their income, whether it's proportionate. So you find an individual that has borrowed so much and at the end of the day remains with very little, if at all anything, to spend. How does the bank protect persons like those when they come to borrow in terms of a mortgage arrangement?
You want to limit how much you are adding as additional loans. And that's why for every application, we always take into consideration all the other loans that you're servicing. First of all, the government talks of the 2/3 rule, that you may not want to lend beyond 2/3 of the pay. And that's something we also play with. It's saying, depending on the customer segment, how much can we take for this particular customer as total loans being repaid out of their income? Because you know they have another life outside repaying the loan.
And now to the elephant in the room, which is the issue of interest rates. COVID has changed a lot of things. People have lost jobs. People have got salary cuts. Businesses are not doing well. And you find somebody who perhaps borrowed right before COVID, who perhaps borrowed at 13% give and take, which is also high by all means, but is now servicing their loan or paying back that loan at a higher interest rate by so much far. How can such an individual renegotiate with a financial institution or with a bank so that they can be cushioned against these very high interest rates?
It's clear that interest rates have, along other costs of living in Kenya, gone up. And not just in Kenya, it's global, that interest rates have generally gone up. And that has followed the other metrics of cost of living. If you look at our fuel prices, where we were in the year 2020 to where we are today. And the primary driver of interest rates is actually the indicative driver of interest rates is the government rates on borrowing. So if you look at treasury bills, back in, say, 2015, December, we closed at 9.81%. Today, we are at 16% on treasury bills. That tells you the cost of funds, cost of borrowing, then tends to follow that. So that then tends to be a factor that will not be in control of either the bank or the client, because that's a market condition that the interest rates are at a certain level. So then what is in control of the client? One is considering to fast track the loan repayment. If you have some extra cash, if you look at your entire portfolio of wealth, you could be having a property that you can say, this I can shift it, dispose it, fast track the loan. Or if you get a bonus, because sometimes people do some windfall, put it into the loan. Just fast track the loan repayment to the point where you will not be able to pay up the loan. We always recommend talk to your banker, have a conversation with them, let them look at your status and have a conversation on the possibility of restructuring that loan depending on what is feasible. By feasible, I mean, do I still have some leg room in terms of the years to my retirement versus the loan ending? Can I stretch that to the latest date of my retirement? Something like that. Or even look at I request for a repayment holiday depending?
You talked about refinancing before. Walk us through the concept of refinancing. If I borrowed from a certain bank and I feel that the repayment is too hefty, I'm not able to handle that, and I want somebody to refinance this loan for me, how do I go about that?
There would usually be two ways. Do you want to take the loan as is, or do you want to give out the loan to the bank and get some extra cash depending on the property value? So what we would look at for a client is the current repayment amount. We would also look at your current income. So it's the normal vetting in terms of ability to pay. Then we can restructure by getting over that loan. But the path to it, it's a simple application with us. Then we agree on the amounts that we're going to give you or the ones that you're looking for. After that, there is an undertaking process to take over the securities in the other bank. So there could be some charges there for valuation, legal fees, and then we will pay the other bank and we start servicing the loan from this other side.
Banks are in business, so there are things that they will not tell you. So when I come here to borrow and want perhaps a mortgage because I have a dream home that I want to live in, would you advise that I take a mortgage against a home that I would like to live in, or is it more advisable to take a mortgage and put the property out there for commercial purposes as a rental, where I can earn rental income out of it and pay the bank back what I owe it?
It's an individual decision depending on your goals. Remember we said a home can be an investment, but it can also be a home. Right now, ABSA is among the shareholders of Kenya Mortgage Refinance Company. So we are actively big in the affordable housing space by giving affordable home loans. And from what we have seen, the customers who are on checkoff, we're able to finance them at 9%. Those not on checkoff, we finance them at 9.5%. Now, when you look at the repayment amounts that are involved, for the affordable home loans that we are offering, it is very, very possible to find a loan, a house that you can afford with the rent that you are paying today, especially in the affordable housing space. That means the customer then can make a decision whether they want to continue renting where they are, because the rent that is coming from the investment that they've made is possible to cover for the current rent that they're paying. But ideally, we would be financing you from a home loan perspective, ideally for your own residence. But then again, if the mathematics add up for you, that remains your call as a customer.
Now, in cases of divorce, separation, inheritance issues, where title deeds and property acquisition becomes a major issue, and yet there's still an outstanding loan, what happens in such a scenario?
Let me start with the couples. It is law in Kenya that you cannot transfer, sell, or mortgage a property without spousal consent. And when you do that, it is null and void. And that's why it is important to always involve a legal opinion as you undertake some of these transactions. So as a bank, we are bound to observe that law, that we need spousal consent when we are talking of a property that this person, the spouse, has agreed to the charging, because as a bank, as you mortgage, you charge that property. You take over the title and you mark your interest there. So that's a legal position which every bank that is law abiding is expected to follow. Now, if you are not married with someone it may not be possible to do a joint application on the basis of that boyfriend-girlfriend relationship. So the question would be, who is the borrower and what's the joint interest? So if there is no legal relationship between those two, it may not be easy to put them in a joint application unless it's a group or a business. But from a residential personal perspective, that is not a space you may find most borrowers going into. When it comes to a mortgage, we give you credit life, in the sense that if a customer is deceased, the insurance clears the loan. So at the point of succession, there's no loan conversation that happens with your estate. So again, those are some of the discussions that we include in our talks around home loans, so that we can educate our customers on what are the legal implications of these positions and some of the innovations around the credit life that guards a property after the demise of the borrower.
Having interacted with developers in the market, they feel that mortgage refinancing firms should work with developers because developers understand the customer base better and they're in touch with the reality on the ground in terms of housing and the housing deficit as well as the housing demand. What's your response to that?
We work very, very closely with developers, and those conversations with developers around master planning, around affordability, around all the issues to do with the real estate sector, we are actively involved there. The other bit we do is that we also partner with other associations. We have partnered with the Kenya Property Developers Association in some forums, and we also work with the key developers in the country, across towns. So when you go to our website, when you go to Finding a Home, you'll find some of the leading vetted developers on our website who we work closely with. And I think also to give an indication of where we are committed, we've worked closely with the National Housing Corporation. We are the first international lender to National Housing Corporation, which is a key developer in the homes ownership space. And that is one of our key partners also. So banks actually need to work with developers. We are actually working with developers closely for that.
That's the Land Conversation today with me, Lillian Muli. Catch us next week, same time, on another exciting episode. See you then.